Is the Baconator making a comeback? Well, I think it may be. So I'm going to talk about what I like, what I don't like, and most importantly, what technical levels are and where the opportunity lies on Wendy stock. That's WEN. Now, full disclosure, before recording this, I literally just entered. So normally I don't have exposure to these companies when I make these videos. However, I literally, on my live stream when I'm recording this, which you come check out, just entered. So I just bought shares of Wendy's. But I'm going to talk about some things I like about Wendy, some things I don't like, so your bull bear points, why I like it, where the technical opportunity lies, and if it may be a good fit for you. So first bull point I like is that Wendy's has a very strong brand recognition. They're the number 3 burger chain. I think that's pretty obvious. You got McDonald's as the big king. Somehow Burger King's up there, which if you've ever been to a Burger King in your entire life, I cannot imagine why that's number 2. I don't. Hey, if I had to pick, I'm picking Wendy's over Burger King, and I think most people watching would, and you could let me know in the comments if I'm wrong, but I'm going to pick Wendy's over Burger King if you put them next to each other. But that's just me. But apparently Burger King's number 2. I don't know about that one. I'm just saying. I don't know. It's got a little bit of a competitive differentiator, which I don't really care about, but some people do with the fresh, never frozen beef thing. What I do like is their marketing. They have very witty marketing. So they have a very unique brand recognition where people know the Wendy's logo, they know their food. I just made a Baconator reference at the beginning. When I say Baconator, you know it comes from Wendy's. You don't think, just like how you think Whopper, Burger King, and Big Mac, McDonald's. They have something to resonate with their specific restaurant. The other bull point, or another bull point I like, is that they're franchise heavy. So some of their competition, like McDonald's, also franchise heavy, obviously, but over 90% of the locations are actually franchised, which lowers CapEx. It means they have lower capital expenditure because it puts some of the costs on, obviously, the franchisee owner. Because this can help drive more predictable revenue and from obviously franchising fees and royalties. So it's basically like a subscription service, right? Where the business of Wendy's doesn't really have to do much. They just collect funds. Now, obviously, they're doing things, but you guys know what I mean. That essentially will lower their operational risk as compared to owning physical stores. So it's not bad that they still own some stores, but having mostly a franchise business allows them to have a little bit of extra flexibility, as I like to say, with how things sit in comparison to their peers, or some of their peers, I guess I should say. I do like that they offer new things on their menu, so they do innovate. And this is something that's more common across other competition, so it's not really a super big bull point, but I think that's something that's really hot right now with fast food chains, and I don't personally really eat fast food, but seeing them innovate and offer different options that are unique, a green hamburger or whatever the hell, those are things that people are interested in and will make them at least go to the store, buy the one green hamburger, and maybe also get something else, right? They've also rolled out breakfast, which, as you can see across all the other fast food chains, has been a hit, and actually has been a sizable amount of U.S. sales now for Wendy's. And they are also experimenting with AI with the drive-thru, so that's also going to help them lower some costs in general, and also increasing personalization, so you could have recommended items to you, right, where you may not previously have purchased them. So think of it like an ad as you're going to Wendy's. You're getting an ad while you're buying the food. Not a bad idea for them. They're also growing their loyalty program in general. So they have the mobile app, they're working on delivery and loyalty rewards. These are things that are, again, across the industry pretty comparable. This is a common trend that we're seeing, so it's not something that's too crazy, but it is something that obviously they're not falling behind with the times is what I'm getting at. And most importantly, what I like the most about this stock, especially at this evaluation, is currently you're getting a 4 to 5% dividend. Now, obviously that can change, but getting a 4 to 5% dividend while you're sitting down here and while you're looking at potential capital appreciation as well is pretty solid. And they've been consistent with their dividend. So that's something that I like versus their peers. You're getting a solid dividend and a solid technical setup, which we'll talk about here momentarily. Now, again, I want to talk about the good things that I like, but I'm also going to talk about the bad things. Now, one of the bear points is they don't have much of an international footprint. So if you're comparing them to McDonald's, they have pretty weak international exposure, which this can be a bear thing and a bull thing. It's a bear thing because they're not competitive outside of this market being the U.S. And they're very U.S. dependent, so if the U.S. economy struggles, they're more than likely going to take a hit. However, there's also an opportunity there that they could expand and move on. Now, they have some expansion in the UK, but still pretty early and not really proven. However, if that proves to be profitable, proves to be well, they could expand even more, and that's a whole new market that's untapped for them, which could be very, very big for Wendy's long term. they're facing decent competition competitiveness, obviously through McDonald's and Burger King already, but other people are starting to take that market share. Chick-fil-A and Shake Shack specifically has been improving in terms of taking market share recently. And obviously these companies are always going to be biting at each other and whatnot, but what the competitive edge for Wendy's has to be is to continue to offer those unique items, or offer unique items to keep up with the competition, because the competition is also offering unique items. So at least having that flexibility, I think, is going to help them stay afloat and hold on to the market share that they have. And as I alluded to the last bear point of them having limited international exposure, that can also be a bull point, because they could have more international exposure, the ability to grow in general. Another bear point, but this is across the board. Things cost more. Labor inflation. Beef is going to cost more right now. So volatile food prices can also obviously impact their bottom line. And as people have to pay more in general, that could impact their bottom line as well. So wage inflation, paying your employees more, which they're going to try to reduce with AI. So that one's going to be across the board thing. So it is a just general sector risk. It's not really a Wendy's risk specifically, but is a sector risk if you're considering investing, whether in Wendy's or McDonald's, any of these other competition, Yum Brands, whatever. That's just a generic sector risk. Two more risks: the reliance on franchisee success. So obviously they have basically the subscription model with franchisees. However, franchisees have to execute. So if they don't execute, then Wendy's isn't making any money. So depending on how franchisees do, that impacts their bottom line. Similar risk with McDonald's, and they tend to not let anyone in, both with McDonald's and Wendy's. They have, at least I've seen in the most recent years, stricter rules for franchisees to apply. So hopefully that will mitigate that risk, but that is still a risk nevertheless. And comparatively, the last risk point on Wendy's is slower growth to peers. Now, while Wendy's does have slower growth, again, this could be a opportunity, because they have slower growth because they're not in as many markets comparatively. So if they can move to other markets, that can open up the doors for growth and give them more profitability. So it is a bear point that their revenue, if you compare same stores to competition, has lagged behind. But if they open to new markets, they could have more opportunity to generate more revenue. So we talked about what I like. We talked about what I don't like. I gave you risk on, risk off. And now let's look at the chart. So Wendy's recently got a little bit of a pop here, and it may be due to the fact that a lot of meme stocks in the food industry right now are getting a little excited. You saw Krispy Kreme recently had a nice pop, and now you're seeing Wendy's get a bit of a pop here as well. Now, again, full transparency, as I said at the beginning of the video, I am now officially long Wendy's. Typically, I'm not, but I was looking to get a long on Wendy's basically at 1088, between 1088 and 1114. Risking essentially this low, because when we zoom out here, and I'll talk about this in a second, that low is a pretty decent risk to reward here, and I'm only risking about like a 10% drawdown on a potential decent upside, and I'm also getting paid while I wait. I'm getting that 4 to 5% dividend. So what I like about the stock, it is in decline. It is a bear moving stock for the most part on the daily, and it did actually have a decent hard push here. But getting this little bump up here on volume and showing a little bit of volatility here before their earnings on the 8th could be a decent sign here, where, again, it's worth the risk to reward. You're getting your MACD flip here, and your RSI is showing some bull momentum here on the daily. The other thing I want you to look at here is the volume increase here on the weekly. So this could be a sign of people getting bullied out of their position, stop losses hitting, etc. But either which way, seeing this volume increase and seeing this MACD slowly start to curl up as your VMA, so your volume moving average, is curling up, is indicative of a potential reversal here on the weekly. But the most important thing, and what I like most about this chart, is the monthly chart, because we have one of my favorite indicators, the 200 MA on the month, acting as support here. So we didn't necessarily tap it the last 2 months, and we did technically wick beneath it this month, but we are currently above it as it stands right now. So this is showing this general area on top of this area being significance, especially above 1088, being a significant support area, with that 200 MA currently sitting at 1074, which is north of that 1030. So again, if I wanted to risk that recent low, that 52-week low, as a risk point where I want to stop out, essentially, you've got a lot of bullish things working for you here if you're patient as an investor, right? So seeing that volume increase and seeing the bears not really being able to push its head underwater, think of it almost like a beach ball, and you're pushing a beach ball underwater and the beach ball's not popping and it's still staying there, and you're pushing as hard as you can and you get weaker and weaker and weaker, and eventually the beach ball pops up. That's sort of what you're cooking here on Wendy's. Cooking here, get it? Burgers. Ha. Sort of what you're cooking here on Wendy's if it can stay north of this 1088 area, which is what I like the most. And you can see if we go back here, last time it broke on the monthly, the 200 MA, which now we're using as support, right? Last time it broke it, you got a hard rally. I mean, you could use this, the 200 MA on any stock. When you broke to the downside here, hard sell-off. So it is a level of key significance, especially on the month. So the fact that we're sitting around it right here really offers you a very unique proposition here for a potential long entry. As we pick up this name out of the doldrums, the gutter, and look at it and go, this might be not too bad. And this may not be too bad, because looking at the daily chart, if we can get out of the woods here, get out of 1190 essentially, which just yesterday it breached above and couldn't hold. But if we can break above 1190, that opens up the door where you could take a little bit of a pit stop here around 1250. So this localized high here where it was old support as well, and push to fill both of these gaps. So you have two open gaps here, one at a very tiny one at the 1380 area, and then another one up here at 1442. So even near term risk to reward here, you can roughly get about 30% gain before you even tap the 200 MA on the daily. Now, again, as an investor, getting in down here, you'll be able to reap the benefits of a 4 to 5% dividend as you wait and as you're patient, where it could grind up once it breaks over basically that 1487, which is your next very, very key level here on Wendy's. You're opening the door to all these levels: 1561, 1601, 1652, 17, 1741, and 1796, and up to 18 and 19. So you open the doors up here pretty quickly, but the two real key levels, and I really should put a line here, and I guess I will now, is 1250 as a key level to confirm a breakout, and then 1487 to give you a longer term breakout. So again, as an investor, you'd want to look for that. As a swing trader, playing to around this 1430 area would probably be where you'd look to take profits as a swing trader. As a longer term investor, getting over that 1487 opens up the doors longer term here for a really solid move on Wendy stock. So that's what I like. What I don't like about Wendy's, and why I think the Baconator, I was gonna say, is back in action, baby. It could be back. So what do you guys think? Let me know down in the comments below if you think Wendy's, it could be a decent opportunity for your portfolio.